This is our second chapter for financial accounting, and the second chapter is discussing recording of business transactions. In accounting, the whole process or the system of accounting is going to start from the first step, which is recording business transactions. So this is a very important chapter from the financial accounting point of view, because the students in this step is going to learn how to record the transactions. Because in double entry system, what we have to do, we have to uh, debit one account, and similarly you have to credit the second account. So what these two accounts, and how do we pass an entry if we buy an asset, what entries we're going to pass when we get cash by selling the stocks. So these are all the things that every business, because businesses are dealing every day with thousands of people, and what is going on with them, there's a transaction going on, and these transactions like exchange of things and money is going to take place, that we have to record. So recording business transaction is the first step in the whole accounting process. So last time in chapter 1 we discusses the financial statements, but that's an end product of the financial accounting. The starting process of financial accounting or a bookkeeping is record business transactions. So let's start. As we discussed in first chapter as well, the balance sheet or the statement of financial position is an equation, and on the one side of the equation is assets, and the other side of the equation is liabilities plus owner's equity. So I explain you in another way that assets, whatever the assets owned by the businesses, can be either obtained through borrowing, or the other way is that the owners are providing finance to buy those assets. So this is the two ways that we can get assets, and that's why assets are always equal to. And it also gives us a good idea that out of these whatever the assets that businesses have is owned or having a interest by the owners, and how much is by borrowing, just by simple borrowing. So account is a record of each assets, liabilities, and stockholders equity elements. So that's the first thing that we have to record, the assets, liabilities, and shareholders equity. So basic summary device of accounting. So now, what are the accounts when we are recording assets? What are the accounts available that what we have to do? Either we have to credit or debit. So the first account which is available under asset heading is cash. So when we buy something, we credit cash and debit the purchases or whatever we are buying. So it means that cash is the one, any transaction what we are doing, either we are receiving cash or paying cash. So one of the account we use for that purposes is cash. The other asset account is accounts receivable. Accounts receivable, when we sell things on credit, so what we enter when we make a sale, or when we what we record is called as an accounts receivable. So accounts receivables are the assets we generate by selling our goods and services on credit. So accounts receivable are the uh, account we use for recording our credit sales as an asset, right? Notes receivable, when we lend some money to anyone, and we in return we get a paper on which the borrower write it down that I will pay you back this much amount on that date. That type of instrument we is an asset, because we are lending someone a money, and that's become an asset for us. So how we record these assets? Under the heading notes receivable. And notes receivables are normally having some interest elements as well, and there are some dates like and these are again the current assets, because it comes under the preview that we will get back within the 1 year something. Prepaid expenses, the expenses which we are paid in advance, which we're going to consume later on, is the account we use as prepaid expenses. It can be a rent, it can be some supplies and all these things that we prepaid, or maybe the bill for utilities, or sometimes we pay bill for sometimes we pay wages in advance as well, like some is so that's one thing we report it as a prepaid expenses. Inventory is the inventories are of different kinds. One of the entry inventory is the raw material. One The other one can be inventory is of a work in process, and the third one is the finished goods as an inventory. So inventories are but again these are assets because we are able to sell it later as an inventory. For merchandising businesses, inventories are all the goods they are buying to resell. Those are inventories. uh, the fixed assets, there are some assets which we report as a fixed assets or a long-term assets, and one of the asset which we are using to report it as a fixed or a long-term asset is a land. The businesses own whatever the land they own, they report it. Buildings, equipment, furniture and fixture. So these are the different heads of assets in which we report different fixed assets. Then we come to the liability side, what accounts we use for liability. One of the very common current liabilities or liabilities which we have to pay within a year is accounts payable. If we buy something, if we purchase something on credit, and the money we have to pay later on for our goods or services what we buy from our suppliers, we report it as a accounts payable. So it's a very similar like an accounts receivable, but accounts receivables are the assets we sell on credit. Accounts payable are the liabilities we buy on credit. So that's the way. Notes payable, again, if we borrow money from the from our other competitors, or we can say other firms as a cash or as a loan, so these are called as a notes payable. It's common in the market, like if it is a trading market, so people buy from each other, borrow from each other. So notes payable, it's a written note provided by our company to other company that we will pay you this much amount of money on that date, and having, if there is a interest element, so we will also pay a certain amount of interest or a certain percentage of interest as well. So this is the third type of accrued liabilities, the liabilities which are the services are rendered or we received it but not yet paid, like the electricity bill or the natural gas bill, or the bill for internet or services, because we use that and then we receive the bill and then we have to pay the bill. So these are the accrued liabilities, the liabilities which are the for against which we receive the goods or services but not yet paid. So these are called as an accrued liabilities. For shareholders equity, we already discussed when we discussed the balance sheet last time. There are five heads that the mostly that common stock, that is the way that we sell the equity. Common stock, retained earning is the other thing that we have to discuss in detail in the first chapter, the statement of retained earnings. So retained earnings is going to report the balance, the closing balance we're going to report, and dividend. So all the transactions which are taking place under stockholders equity that is going to affect the stockholders equity are the change in common stock, whether we issue more stocks, so we add up to the common stock, or retained earnings. So if there is an increase at the end of the accounting period, if the income is increasing, that is increase in the retained earning. Or if we pay dividend to the stockholders, then it's going to be increase or decrease in the retained earning as well as in the stockholders equity. Revenues and expenses are affecting in the stockholders. So if there is an increase in revenue, definitely the stockholders equity is going to increase, and if there is an increase in expense, that is going to reduce the stockholders equity. So these are main commonly heads of account. So it can be many more, we can add up to the list many details, or in going into subdivisions of these assets and liabilities, but in broader terms, these are the accounts we use to pass journal entries or record the entries in our first book of entry in order to start our accounting process. So this is, so common stock or a shareholders equity, common stock, owner's investment in the company, retained earning is a cumulative net income or a loss, dividend. Dividend is a distribution to the owners. Revenue increase in the equity from providing goods and services, and expenses are the cost of operating a business. So these are the things that relates to stockholders equity account. Now, accounting for business transactions. Transaction is an event. Now, what is the definition of a transaction? Transaction is an event that both affects the financial position of the business entity and can be reliably recorded. So we call it as a transaction and we record it. If it is going to change the financial, if there is just a contract without involving a real change in the financial position of the business, that is not a transaction. So transaction is a event that is going to affect the financial position of the business. So let's start. It's an example, and we have to try to understand. Students invest 50,000 to begin a Terra corporation, and the business issues common shares. So what we are doing? We are starting a business, and what we are doing? We are investing 50,000 as a student into the business. Now, what is this? This is an equity, and under equity we discussed there are different accounts. So one is a common stock, the other one is a retained earning, the third one is a dividend, and fourth expenses and revenue and fifth one is the expenses, and fourth one is the revenue. So if you read it again, invest 50,000 to begin Targa. So it means it is not a withdrawal, it is not a retained earning, it is not an expense, it is not an revenue. So what it is? It is a common stock. So the entry is going to pass, like assets is going to increase. Why? Because we are getting cash, 50,000 cash. And what is going to happen? The shareholders equity is going to be increased. So 50,000 is going to increase in the shareholders equity, which is a common stock, and assets are increasing on the other side. So you see here the point we want to make it here. It's again balance, like 50,000 on the asset side, on the other side there's an increase in the shareholders equity. Tata Corporation purchased land and pays 40,000 in cash. Now, what is impact on the equation of the balance sheet or the business equation? Assets, liabilities, shareholders equity or owner's equity. So what is the change? Now, what we are doing, we are buying an land, an asset, and what we are paying? We are paying cash. So it's an increase in asset as well as decrease in asset. So it's only changing on the one side. There is no other side change. So you see here. So what is happening? Sorry, it is going to be 10,000. It's not like, right? So 10,000 cash remaining, because 40,000 we use cash for buying land, and by this way it is a cash and land, cash and land. Now we have two assets. Before that there is only one asset, which is cash. Now we convert it into another asset, and that is land of a 40,000. So you see, again, the important thing is that the balance is still there. It should be equal, and that's why we call it as a equity. Business buys transaction stationery and other office supplies on account, agreeing to pay 3,500 within 30 days. Now what it is? Now okay, it's a cash and it is 10,000, and land 40,000, 40,000, and supplies is our third asset, which is 3,700, and altogether it is 3,700, and altogether we have a 53,700 on the asset side. But on the liability side, what is changing? The 50,000 equity is still there, but we are adding up which is payable. So supplies, we are buying supplies on credit. So it's a liability. We have to pay in future. We mentioned that we're going to pay in 30 days. Now, Tata Corporation earns service revenue of 7,000 and collect this amount in cash. Now revenue, you remember that is going to increase our shareholders equity. So what we are adding up towards the shareholders equity. But at the same time, what we have to do, that we have to add up somewhere on the asset side, because it's going to be balanced, and that's a cash. We are receiving cash. So cash on the asset side, and owner's equity or shareholders equity on the other side, and again there is a balance. Okay, so Tara Corporation performs service and earns 3,000 on account. So we see here that Tara Corporation provided some services, but on credit. So for that reason, what we have to do, we have to add an asset which is of a receivable, and on this side we add up as a revenue. So we see here the shareholders' equity is increased by 60,000, and 3,700 is the liability, and overall asset is 63,700. Tara Corporation pays 2,700 for the following expenses: office rent, employee salary, and utilities. And we know that all expenses is going to be subtracted from the shareholders' equity, as well as is going to reduce our cash. So we see here that expenses altogether, one is 2,000 pay for the following expenses. So 2,700 is the total expense under three days active. So we see here that we subtract it, and here we reduce the cash. So the asset is reduced. Tara pays 1,900 on account for supplies purchased in transactions. So now what we are doing, we are decreasing our asset, which is cash, and also at the same time we are decreasing our liabilities, because we are paying back our liabilities. So we see here the cash is reduced by 1,900, and its liabilities also increased by 1,900. The owners pay for the remodeling of his house at the cost of 30,000. Now this is a very important point to note it here. Owner's own house is not a business entity, is not having to do something with the business. So this cost is the owner's personal cost, which is not going to record in the business. So there is no entry, personal entity, not the business entity. So that's the reason that we are not going to record these transactions. So no transaction is recorded for that. The business collect 1,000 from a customer. So there is a receivable, accounts receivable, that is going to reduce, and cash is going to increase. So you see here there is a 1,000 increase, and there is a 1,000 decrease, and there is no change. Sell parts of the land purchased in transaction 2 for 22,000. Now we are, what are doing? We are getting cash which is of 22,000, and at the same time what we are doing, we are reducing the land which is of a 22,000. So land is reduced by 22,000, and cash is increased by 22,000. The corporation declares a dividend and pays a 2,100 cash for the shareholders. Now cash dividend is going to affect our shareholders equity and cash. So you see here cash is reduced, and shareholders equity is also going to be reduced by this transaction. Now we summarize this whole scenario. So we have a asset left as a supplies. Uh, the accounts payable is still 3,700. On the other hand, we have a this one is the land, and land is reduced by 22,000. No transaction for the businesses, and all other transactions we can see here for. So altogether we see here the liabilities plus shareholder. So this is the asset side, and these are liabilities and shareholder side. So asset side is altogether is 3,300, and liability side is shareholders equity, and there is some adjustments of revenues and expenses as well as dividend. So we see that. So income statement data appears as a revenue and expense, and under retaining earnings, the revenue increase retained earning, the expense decrease retained earning. So balance sheet data are composed of the ending balance of the assets, liabilities, and shareholders. Statement of retained earnings repeat its net income or a net loss from the income statement, and dividends are subtracted, earning endings is. So these are the things that we already discussed in our chapter 1. Income statement, So we can say that what is an income statement for this entire corporation. So services revenue is 10,000, 3,000 on credit, 7,000 on cash, so that's a 10,000. Expenses are salary, rent, utilities, so total expenses are 2,700, so net income is 7,000. If we look at the retained earnings, so we don't have any because this is the start of the business, so there is no opening balance for retained earning. Add net income for the month, and then we subtract the dividend, and this is going to be retained earning of 5,200 for this period. Yeah. Balance sheet, so we see here that assets, cash, accounts receivable, office supplies, land, so these are all the assets what we have. So 57,000 is the total assets we have. And on the other side we have a common shares on which we have a retained earning, and retained earning plus liabilities, so we see this all together is 57,000. uh, so it's going to be liabilities are here, I think it's missing, like accounts payable, which is of 2,000, so it's 52, and which is 1,800, sorry, 1,800. If I take you back to show you this, uh, you see here liabilities are 1,800, so we have to report it here as 1,800. So if I make it correct, like a 1,800, and that's going to be the total, and the totals are same. So we see accounts payable 1,800, and we see this one. So up till now, what we discuss in this chapter is just what is an impact of a transaction on the asset, liabilities, and the shareholders' equity. We just we try to understand the impacts. This is not a recording of a transaction. It is just to understand the impact of a transaction. In our second part, we're going to learn what is the how to record the transaction. So we just understand the different accounts of assets, liabilities, and shareholders' equity, and also what is the impact of every transaction on the asset and the liabilities, because it's a double entry system, and in a double entry system we have to record both the debit and the credit. So please continue watching. In the second part we're going to discuss about the recording of transactions.